Sounds great. Well, thanks for joining, Patrick and Evan. I'm Andrew, as you know, and we have Susan on today to discuss HECM, which is another name for reverse mortgages. And I think, as I begin to introduce Susan, what the questions I always get about it, Susan, is like, when does it make sense? Are the closing costs 50 grand? I get these crazy questions that I'm sure you get all the time. And I actually worked for a company going back about 10 years ago, and they had a whole HECM division. And so all they did was these reverse mortgages. And when people ask me about the tool, and this is probably not good advice, but I always say, like, it absolutely has its time and place. Like, for the right situation, it's an extremely useful tool. And so I think for the financial advisors joining us, this is just another great option to have available for your clients that could be extremely beneficial in the right circumstances. And so with that, I think, Susan, I'll let you dig into the programs and kind of dispel some of those myths that have evolved in the market, and talk more about the program. So thanks for joining us.
Oh, thanks so much for having me. Thank you, everyone. Nice to see everybody and be here. And I appreciate the opportunity to, like Andrew said, let's get through the misconceptions and let's talk about how the program actually works. And he's truly right. It's not for everyone. And me and my team, that's all we do every day. And we guide the consumer to ensure that it's the right tool. But it's important for financial planners to know about it, to understand it, to see if it could benefit their clients. So we're going to talk about exactly what the title says, housing wealth versus assets under management, because what we're seeing is people are, tapping into their investments a lot more. We didn't save enough, we're living longer. And so what happens? So why not tie in housing wealth to help preserve their assets under management? So we're just going to go through a few different things: the history, program overview, repayment, managing risk, and inflation, which is a big subject right now. Let's get over these misconceptions. And then I'm going to show a few different scenarios on how the program worked for various clients that we helped. And if you have any questions, you can put them in the chat. James can let me know if he needs to stop me. And if not, we can go right to the end, and have any questions, just let me know. So let's talk about the history. So believe it or not, the first reverse mortgage was done in 1961. It was done in Portland, Maine. A gentleman that owned a small community bank gave his football coach's widow a reverse mortgage. So it's been around, the concept has been around for a long time. Back in the late 80s, that's when FHA, HUD got involved in it, and President Reagan signed the pilot program into law. So I was fortunate. I'm from Rhode Island, if you can't tell by my accent. I worked for a quasi housing agency, and we were one of the 50 companies picked for the pilot program. So I've been around for quite a while. I always say my parents put me to work at the age of 12. But I've seen the program just improve over time. So in 1989, the first reverse mortgage, HECM, home equity conversion mortgage, was issued. And then in 98, it became permanent. And around 2010, even a little bit before that to today, HUD has implemented so many safeguards for the consumer and their estate. And the program is really for the consumer. So years ago, people would say, reverse mortgages aren't good. That's not, I wouldn't recommend it. They're going to take your house, and we'll go through the misconceptions. But I will say the home equity conversion mortgage, the HECM program, was always insured by FHA, always had safeguards in place. The safeguards are getting even better lately, but they were always a safe product. So reverse mortgages, people love the concept of the HECM, so came up with their own. We came up with our own. We called it a reverse annuity mortgage. It wasn't great. It didn't follow the same guidelines that the HECM program did. So those are all gone. Today's reverse mortgages are just as safe as the HECM program. And we're going to go through the difference of the two. So with the home equity conversion mortgage, the HECM, it's available to those 62 and older. It's insured by FHA, and the national lending limit is $970,800. Now, the borrower has different payment plan options, which are a monthly payment, that they would receive a monthly payment. They could get a line of credit. They could get some money at closing, or a combination of those. But the best part is, regardless of what they pick at closing, they can change their payment plan at any time as often as they need to through the life of the mortgage. The servicer will charge a $20 change fee, but this is so unique, whereas it can help them throughout their retirement as their life changes, as their situations change, they can change that payment plan option. So I think that's pretty valuable. Now, a reverse mortgage is typically a proprietary jumbo product, and that's available to those 55 and older in most states, Massachusetts at 60. The loan amounts are up to 4 million, and they can either get a lump sum, a line of credit, or a term payment. So the reverse mortgage, though not insured by FHA, still follows the same guidelines, the same safeguards as the HECM program. So today's products are very safe for the consumer and their estate. So let's talk about repayment. So obviously, a reverse mortgage, we're paying them. They don't have a mortgage payment, though they can make one if they wanted to, but it's not required. They are still responsible for their taxes and insurance and upkeep of the home, but we're actually paying them. When does it become due and payable? When the borrower moves out of the property, sells the property, or the last surviving borrower passes away. Now, the nice tax benefit for tax deduction will be paid when the last surviving borrower passes. So all that accumulated interest is getting paid at that time. So I've seen a lot of financial planners and estate attorneys use that tool, that tax deduction, for estate planning. So we always say, speak to a tax advisor, a financial planner, but it may be eligible for that tax deduction for estate planning purposes. So keep that in mind, because that's when it's all getting paid off. So let's talk about what's going on today. Inflation is hitting us all, right? So we're all dealing with it and trying to get by. But when someone is retired, they're typically on a fixed income. I was speaking to a financial planner a few weeks ago who told me that he has clients taking anywhere from 13 to 17% withdrawal rate each year. He said they will be out of money in 3 years, and rightfully so. I mean, if the market's down and you're tapping into your retirement investments, you're going to run out of money a lot sooner, and we're living longer. So what other options do we have? What other tools can we put into this retirement income planning? So longevity, we talked about that. Sequence of return risks, that's been around forever. I mean, financial planners have loved that about this program, so that they can preserve their clients' investments. Long-term care, whether they couldn't afford it, couldn't qualify for it, people want to age in place. They want to stay home, especially after COVID. They don't want to go to institutionalized care, rightfully so. So how about being able to afford long-term care at home? And then forced retirement. During COVID, we saw a lot of people were forced into retirement. So what are their options? Claiming Social Security too early? I mean, that's never advisable. So not looking at housing wealth could really make their situation dire. So let's talk about the misconceptions. And I say, as an industry, shame on us, because I've heard these same misconceptions when I started this program back in the late 80s. So that's not good. So let's get through them. So it's a mortgage. It's a mortgage lien, just like a regular mortgage. The bank does not own the home. They still have ownership to the home, and they can sell it at any time and do whatever they want. So it's a mortgage lien against the property. We always make sure that we pay off the existing mortgage first, obviously, so we'd have to satisfy that. And sometimes that's all we can do, which is fine, because let's say they had a $1,500 a month mortgage payment and we were able to satisfy that lien. At least they're putting $1,400 in their pocket each month. So, they're supplementing their own income. The proceeds are considered income tax free. Now, we always say talk to an advisor on that also, but it's not income. It's a debt that has to be paid back. So it's not taxed. They can use the money for any reason. It's their money. It ranges from some of the things that we just talked about to, home modification to make the home safer, maybe moving a bedroom downstairs, going on a vacation. I mean, they can do whatever they want with the money. Both products, the HECM and the reverse mortgage, have what's called a non-recourse feature. And what that means is the borrower nor their estate are ever personally responsible for the debt. Only the home is. So we think about like in '08 when everybody was underwater, well, so were HECMs and reverse mortgages, but because of that non-recourse feature, the estate nor the borrower is ever personally responsible for that debt. Now, years ago, they talked about HECMs and reverse mortgages being the loan of last resort. And maybe the concept in those days, that's kind of how it fell into that category, but it's not that way today. Even though we don't qualify them like a regular forward mortgage, we still have to do a financial assessment piece and a residual income piece, which is similar to VA. So at a last resort, we probably couldn't help the borrower. So nowadays, it's actually used as part of the retirement income planning and early on, like I mentioned. So let's talk about the power of the HECM line of credit. So in this situation, we have Tom and Ann, they're age 65. We're paying off their current mortgage, so they're going to be supplementing their own income per month of $1,400, and we're going to give them a line of credit of a little over $74,000. Now, the best part of the line of credit has a guaranteed growth feature. It's not free. Whatever they take, they have to pay back. But let me show you an example on how that grows. It's kind of small here, but I'm going to just tell you. So that $74,000 at time of closing, by year 5, it's over $94,000 that's available to them. In year 7, over $103,000. Now we show it annually on this amortization schedule. They'll actually see it monthly in their statement. But let's say they didn't need the money for 5, 7, 10 years. That's that much more money that they'll be able to access. Guaranteed growth, regardless of what's going on in the market, the housing market, the financial market, it's guaranteed growth. And I don't really know any programs that can give you guaranteed growth like that. And the nice thing about the line of credit, so different than a HELOC, we can never freeze it. We can never call the note. It's theirs for as long as they live in the property as their primary residence, and they can access it as often as they need to for as much as they need to. And it goes right into their checking account when they request the money from the servicer. So it's really amazing how having that flexibility or that emergency fund, or when the market's down, don't touch your investments, touch the line of credit. And I'm going to talk about a case study that Barry Sachs did that I love, and it really reinforces how important this is and to do it at age eligible. So we got numbers a few months ago that seniors are sitting on over $10 trillion of housing wealth. They're just sitting on it. What are they going to do with it? They're just sitting on it. It's so important to tap into it to help make their retirement that much more enjoyable. You know, like I said earlier, we're not tied to the markets, whether it's the housing market, the financial market. So like that growth will always be guaranteed. I'm going to talk about the legacy when I talk about the study that Barry Sachs did. And then these statistics I found, I was like, this is crazy, but it's true. 45% of baby boomers have no retirement savings. And I say primarily because I call them the sandwich generation. They're taking care of their grandchildren. They're taking care of mom and or dad financially and physically. I mean, I know when my mom was elderly, my sister and I helped pay for her prescriptions, helped pay for her groceries, whatever the case may be. So if baby boomers doing that with the grandchildren and the parents, how do they have any money left over to put into their retirement savings? And it's going to be a big issue when they go to retire, when they're not going to have the money that they need to live. I mean, they estimate, I think it's like a 30-year retirement. So that, you know, that's really serious issue in this country, in most countries. 90% of retirees receive Social Security benefits. And I think that is probably even higher because of COVID. I saw that a lot of people were tapping into Social Security a lot sooner than they originally planned. And then 57 of Social Security recipients take their benefits before reaching age 70. We can use the HECM line of credit to have them postpone or defer Social Security till age 70 so that they can get the most. You know, and I've seen a lot of financial planners doing that because people want to just collect Social Security and they're cutting themselves short each month, when if they waited to age 70, they get the full benefit. So let's talk about Mary. Mary lost her husband, so then lost about $1,200 in monthly income because she's down to one Social Security check. We were able to give her a little over $1,300 put some money in a line of credit, 25,000 for emergency, the car breaks down, the house needs repair, whatever the case may be. And we also gave her $5,000 at closing to do some repairs. So now she's got more income coming in. She's got that line of credit for security and emergency, and she gets to do some home repairs. And in this case, we should show again that 25,000 at closing. In year 5, it's a little over 31,000. In year 7, 34,000. In year 10, 40,000. So let's say she doesn't really need to touch it because we're giving her that monthly supplement, that over $1,300. That's growing for when she needs it, but it's there and she can access it as she needs it, when she needs it, for as much as she needs. So pretty powerful stuff. So COVID saw a lot of divorces. So we call them silver divorce. So in this situation, we have Ricky and Lucy. They're 67, they're getting divorced. Ricky wants to stay in the home. It's worth $600,000, so he has to pay Lucy $300,000. We're able to refinance the home for Ricky. Now he has no mortgage payments. He's responsible for taxes, insurance, and upkeep of the property. And we're able to give Lucy $300,000 from the HECM refi. Now Lucy's gonna buy a condo, which she could go buy a condo for $300,000 and pay cash, but then that's gonna leave her with nothing. Or based on this scenario, she wants to buy a condo for $400,000. She could put a down payment and do a regular forward mortgage, but then she's going to have a mortgage payment. So how about this? Lucy's going to put $200,000 down on the condo. The HECM for purchase is going to give her $200,000. She has $100,000 left over that she could put into retirement investments to help make her retirement account that much better. How many people wouldn't love that? And she has no mortgage payment. And she's just responsible for taxes, insurance, and condo dues. So it's just the perfect situation. And we're seeing, which I was kind of amazed because I thought with the market and how inventory is so low, that HECM for purchase would be as popular as it is, but we're getting tons of them. So, you know, I think it's more so by not having that mortgage payment. And people are, we call it right sizing in some cases. They may be moving closer to the children or the grandchildren because they felt isolated, you know, through COVID. Maybe the kids don't live in the same state anymore, so they're moving closer to the kids and the grandchildren. But we're seeing a lot more HECM for purchase than we ever did, and reverse for purchase also. And that's just that one. Okay, so this is the research. So I want to say, if you're not following Wade Pfau or Jamie Hopkins on LinkedIn, do it. They have so much information, so valuable information. Wade just updated his reverse mortgage book. It was the beginning of this year. Jamie wrote a book about reverse mortgages and rewiring and rethinking retirement. But one of my favorite studies is the first study listed here, and you could look it up. It's from Barry Sachs and Mary Jo Lefay. And what he did was they looked at someone that had a modest portfolio, 500,000, at age 62, had them take out the HECM line of credit and leave it there until they needed it. It's growing. And with a 30-year retirement plan, when the market was down, that following year, they tapped into the HECM line of credit instead and left their investments alone. So they tapped into that line of credit about 7 times in that 30-year period. Not only did they grow their modest $500,000 portfolio to over $1 million, that now they have a bigger legacy to leave the children, and they only touched the line of credit 7 times, therefore not eating up all of their equity. So it's a great case study. I highly recommend you looking into that. And also, again, Wade and Jamie, they have such valuable information. And Wade's on a book tour, I think. So I've seen him a lot on LinkedIn with recordings and stuff like that. So you can jump on and listen in at your convenience. But it just goes to show that people have been talking about this for a long time. I think it's becoming more popular now just because of inflation and all the things that we're dealing with in this country. So it's just another tool to put in your toolbox to help, you know, preserve your clients' assets under management, grow that, as opposed to just sitting on all this equity and not making it work for them. You know, my parents had me late in life, and my dad worked 2 jobs to pay off his 30-year mortgage, really. And we had a mortgage burning paper party. I mean, it was real in that day. You know, people think, oh, we have to pay off the mortgage and then we're just going to sit on all this equity. but it's not doing anything for them. So it's becoming more and more popular in the financial planning world and in general. I mean, estate attorneys, elder attorneys are looking at this product more and more. So I think it's just something that you need to know. And, Andrew talked about in the beginning how people say, oh, it's so expensive. And it's like, it's closing costs, just like a regular mortgage. You have to pay your appraisal, you have to pay for your credit report, you have to pay for your attorney fees and the recording fees. It's typical closing costs that would be associated with any kind of a mortgage that are paid to third parties. There's no junk fees, hidden fees. You can't do that. HUD is very strict on fees. One thing that is paid to HUD is the upfront mortgage insurance premium, and that's 2% of the appraised value. But it's important. Just like homeowners insurance, car insurance, we pay for it and hope we never need it, but we still buy it and pay for it, right? So with the upfront mortgage insurance premium to HUD, it covers two things. Let's say the lender goes out of business and you have 200,000 in a line of credit. HUD goes right into first position so that you could still access your money. Very important. And then that non-recourse feature. So it makes sure that the borrower nor the estate are ever personally responsible for the debt. Only the home is. Now, the reverse mortgage, though not insured by FHA, still has those same safeguards. There's just no upfront mortgage insurance premium. But typically, again, that's for a jumbo product. So we're seeing a lot more of them too. California's been really busy with our reverse mortgage jumbo product. So if you would like me to just run some quick numbers, you can get this information to Andrew. He can get it to me and my team. We're an extension of his team. This is what we do every day and all day. That's all we do. And we'll be able to give you an illustration on how the program could work for your client. And there's no obligation. It's just to run the numbers and so to see if it fits into their retirement income plan and what you're trying to accomplish for them. So feel free to get that information out to Andrew and we will work on it for you. And with that, I think we're right towards the end. So we have 4 minutes for questions and answers.
Does anyone have any questions out there?
You can type them in if you're shy.
No questions on my end, but I appreciate the quick synopsis here and the time, of course.
Yes, we wanted to keep it short and sweet just to get you the information.
Yeah.
So yeah.
Sure.
And it is, I mean, it's a valuable product. I mean, like I said, it's really been helping. It's the best job I've ever had. I mean, I did forward mortgages too during my career, but it's just so rewarding to see how you can financially help a senior, a retiree. It's amazing. And that stress that they go through when they're eating up all of their retirement investments and they don't know, where they're going to get extra money. So it's just another tool for your toolbox for sure.
Yeah, some really powerful stuff there, Susan. I think it's awesome just to know that there's products like this out there. And I think it really can open up some doors for some certain families. So yes. I think it's awesome to have it in your bag of tools. Just to know about these things is great. So thank you so much. It was really informative. Thanks, Patrick and Evan, for hopping on. We really appreciate you coming today. We have recorded this as well. So if anyone on your team or anyone else wants to hear about this, just let us know or let me know, and I can forward the video to those guys as well. So
yeah, definitely. Thanks. I think it's awesome, the idea that you could really have some flexibility in terms of reducing your mortgage expense, getting potentially a lump sum, which could help eliminate other expenses potentially, or bolster your savings and possibly reinvest that. So yeah, I think it's really versatile with everything. Plus you can get some form of a income stream. So I think it could be really useful for a lot of people. Thank you.
Thank you. I agree. Thank you.
Awesome. All right. Well, thank you everyone for joining us. Susan, it's been great. And yeah, we'll be doing another one shortly with you. I can see doing this often in the future. So
awesome.
We really appreciate it. Like I said, I do have the recording and yeah, we'll be in touch.
Great. Thank you. Thanks everyone for joining. Have a great day.
All right. Have an awesome day, everyone.
Bye.
Bye.